The head and shoulders and inverse head and shoulders are a type of common reversal pattern found at the end of major trends. The bearish version is called the head and shoulders pattern, while the bullish version is called the inverse head and shoulders pattern. In this video, I'm going to talk about how to take advantage of the head and shoulders pattern to identify major market reversals and the best trading strategies for this price pattern. Hi, this is Spencer, founder of Synapse Trading, and I've been trading and traveling across the world to teach and inspire others how to do the same. Firstly, what is a head and shoulders pattern? The head and shoulders pattern and the inverse head and shoulders pattern are types of common reversal patterns found at the end of major trends. When prices are unable to surpass the prior swing high, which is the head, and forms a lower high, which is the shoulder instead, this forms the bearish head and shoulders reversal pattern. When prices are unable to surpass the prior swing low, which is the head, and forms a higher low, which is the shoulder instead, this forms the bullish inverse head and shoulders reversal pattern. Next, what is the psychology of the head and shoulders pattern? Here's a quick recap of the two types of pattern: the head and shoulders pattern, which is a bearish reversal, and the inverse head and shoulders pattern, which is a bullish reversal. So first, for the bearish reversal version, in the head and shoulders pattern, the bulls, which are the buyers, are originally in control of the market, and the market is in an uptrend. At some point in time, the bears, which are the sellers, try to take control, pushing down prices, which creates the left shoulder of the pattern. The bulls resume control and push prices to new highs, which forms the head of the pattern. Bears try to fight for control again, pushing prices back down to the level of its first push. The bulls try one last time to resume control by pushing prices up, but is unable to make new highs, and this forms the right shoulder of the pattern. Finally, the bears take full control and push prices further down, and the bears are now in control of the market, and the market is in a downtrend. Next, for the bullish version, which is the inverse head and shoulders pattern, in this pattern, the bears, which are the sellers, are originally in control of the market, and the market is in a downtrend. At some point in time, the bulls, which are the buyers, try to take control, pushing prices up, which creates the left shoulder of the pattern. The bears resume control and push prices to new lows, which forms the head of the pattern. Bulls try to fight for control again, pushing prices back up to the level of its first push, and the bears try one last time to resume control by pushing prices down, but is unable to make new lows. So this forms the right shoulder of the pattern. Finally, the bulls take full control and push prices further up, and the bulls are now in control of the market, and the market is in an uptrend. So what are the trading strategies that you can use to trade the head and shoulders pattern? There are three main strategies which focus on taking advantage of the change in the trend, and the difference lies in how early to enter the reversal when it happens. For the first one, we have the early entry, which is to enter immediately. Number two, we have the pre-breakout entry, which is to enter immediately as well once you see the breakout. And the third is the pullback entry, which is to wait for a pullback after the breakout. Since the head and shoulders is a reversal pattern, we can expect to see its swing counts change as the pattern unfolds. For the bearish reversal of the head and shoulders pattern, we see the swing counts change from a series of higher highs and higher lows to one of lower highs and lower lows. For the bullish reversal of the inverse head and shoulders pattern, we see the swing counts change from a series of lower highs and lower lows to one of higher highs and higher lows. For all three strategies, they involve entering a position at various stages during this transition of swing counts. Now let's go through each strategy in greater detail. For strategy number one, which is the early entry, the first strategy for the head and shoulders price pattern is to enter early as the second shoulder, which is the right shoulder, is forming by using the first shoulder, which is the left shoulder, as a guide. As mentioned previously, the head and shoulders pattern is a reversal pattern, and we can expect to see swing counts change as the pattern unfolds. The early entry takes advantage of this by shorting on the first lower high, which is the bearish head and shoulders reversal, or going long on the first higher low for the bullish inverse head and shoulders reversal. You can scroll up to the previous infographic, which is the entries in head and shoulders pattern, to observe where the color changes. In the examples above, we see a prior trend followed by the head and shoulders pattern, which attempts to change the direction of the trend. The first sign of the change of the trend comes from the second shoulder, which is the right shoulder, because it is not able to reach the same level or exceed the head, which shows that the existing trend is weakening. Most of the time, the second shoulder, which is the right shoulder, will form at roughly the same level as the first shoulder, which is the left shoulder. This means that we can preempt the potential turning point of prices and use that for our early entry. For trading, we will look to enter near the point of the second shoulder, keeping an eye for reversal candlestick bars or price action and volume, which signals that the momentum is weakening and it cannot go past the shoulder level. We can then look to place our stop loss somewhere between the shoulder and the head levels. This strategy works best if the price movement to resume the current trend is weak and looks to be struggling just to touch the shoulder level, which suggests that it will most likely not be able to go past. Our second strategy for the head and shoulders price pattern is to enter on the breakout or breakdown of the neckline. As mentioned previously, the head and shoulders pattern is a reversal pattern, and we can expect to see swing counts change as the pattern unfolds, meaning a lower high and lower low if we want to short, and a higher low and higher high if we want to go long. In the previous strategy, which is the early entry, the entry was given on the first lower high, which is shorting a bearish head and shoulders reversal, or the first higher low if we are going long on a bullish inverse head and shoulders reversal. In this strategy, which is the breakout entry, the entry is given on the lower low or the higher high. Breaking the neckline automatically gives rise to a lower high and lower low respectively. In the examples above, we can see the neckline, which is the blue horizontal line, which denotes this crucial price level. Sometimes, if there's no clear neckline, this might result in a zone or multiple necklines. For trading, we will look to enter just as the breakout occurs at the neckline, keeping an eye for strong price action and volume, which signals conviction in the breakout. We can then look to place our stop loss somewhere between the neckline and the second shoulder, which is the right shoulder. This strategy works best if there's a clear neckline which price is trying to break, followed by a strong price momentum on the breakout. If the price action is choppy or volatile, or if the neckline is not clear, then it will be better to wait for a pullback and use strategy 3 instead. This brings us to our third strategy for the head and shoulders price pattern, which is to wait for the break of the neckline to occur, which was what we saw in strategy 2, and then enter on the first pullback after that happens. As mentioned previously, the head and shoulders pattern is a reversal pattern, and we can expect to see swing counts change as the pattern unfolds. In the previous strategy, we shorted on a lower high, which is for strategy 1, and lower low, which is for strategy 2, or we went long on a higher low, which is strategy 1, and higher high, which is strategy 2. In strategy 3, we will be shorting on the next lower high or going long on the next higher low. Therefore, since the new trend is slightly more established, the chance of success is higher, but the reward to risk ratio will not be as good as the prior strategies. As we mentioned many times before, every trade is a trade-off between the hit rate and the reward to risk ratio. In the examples above, we can see where the first pullback occurs, which is the yellow highlight, depending on which neckline you treat as the breakout. Most of the time, the pullback will retrace to touch the neckline, but if the breakout momentum is strong, the pullback may not come all the way back to the neckline. For trading, we will look to enter near the point of the breakout, usually near the neckline, keeping an eye for reversal candlestick bars or price action, and volume, which signals that momentum is weakening and it cannot go past the neckline. We can then look to place our stop loss somewhere between the neckline and the second shoulder, which is the right shoulder. If you have already entered a position during the breakout, this strategy can be an opportunity for you to add on more positions. So how do we get a profit target for the head and shoulders pattern? Once a head and shoulders pattern is completed, One of the most useful things about it is its ability to provide a price projection which can be used to estimate a minimum profit target for your trade. This can be done by taking the maximum height of the pattern, which is the distance from the head to the neckline, and projecting that distance from the breakout point. If the neckline is not clear or if there are multiple necklines, it is advisable to go with the most conservative option and use a smaller projection. In the chart above, the maximum height of the head and shoulders pattern is indicated by the blue rectangular box, which is then used as a price projection at the breakout point. The horizontal arrow indicates the price level which serves as the minimum profit target for the head and shoulders pattern breakout. This price projection technique can be used in conjunction with other methods such as support and resistance levels, and if there is any confluence, gives an added layer of confirmation. Here are some additional tips from the trading desk. Number 1, make sure the trend is in the late stage, because the longer the trend has been running, the more exhausted it is likely to be. Number 2, use the completed pattern for price projection. The shoulders tend to be roughly the same height. And number 3, the size of the pattern should be proportional to the trend it is trying to reverse. As you can see from the chart above, this is an example of a strong trending market. If you look at the 3 green rectangular boxes, which ended in a head and shoulders bearish reversal, which is the 1 red rectangle box. This means that for the whole move up, if we only measure the vertical distance, which is the height, the trend accounts for 75% and the reversal pattern accounts for 25%. This is within the healthy range, meaning that the pattern size is proportional to the whole trend. Typically, a reversal pattern works best when its height is about 25% to 33%, which is 1/4 to 1/3 of the whole move. If the pattern size is less than 25%, the pattern is too small to reverse the trend, which means that it might likely lead to a consolidation before the trend resumes, or the reversal pattern is still in the midst of forming and might evolve into something bigger. If the pattern is larger than 33%, the pattern is too large to be classified as a head and shoulders pattern, and it could just be large swings within a wide range. I have not come across any authors talk about price pattern proportionality in any books, but I see a lot of new traders making this mistake when trying to identify price patterns. And this applies to other price patterns as well. Now that I've shared the various trading strategies for the head and shoulders price pattern, which is your favorite strategy? Let me know in the comments below. And if you have enjoyed this video, do remember to like and subscribe and hit the bell notification icon to receive the latest update. That's it for this video, and I'll see you in the next one.